Let's now catch up with what we're seeing more broadly at the moment. Grant Mundell is from Equity Trustees, joins us for the firm's FY26 market outlook. Grant, welcome back. Good to catch up with you. You have released your market outlook and you're saying, well, with a global picture here, the focus being economic growth likely to slow into the second half, what effects is that likely to have, particularly from an investment perspective, do you think?
Oh, look, I think the key things that we've got to be factoring on, obviously the first half was supplemented by a pull forward in demand. That was prior to the enactment of the US tariffs. So we do think we'll see a slowing in economic growth really in the second half. And that's even probably before any major negative impact from the tariffs on US consumption. So we are expecting sort of global economic growth to slow in that second half, remain below trend, but not fall into recession. And more locally, we think GDP growth in Australia will probably, again, remain below trend, but actually gradually improve to around 1.7% by the end of this year. And that's obviously supported by RBA rate cuts and continued public spending.
Yeah, how do you see that falling, Grant? It's sort of a double-edged sword, isn't it? So clearly rate cuts supportive of asset price growth, yet it's an indicator that the economy needs that support. It's weakening.
Yeah, absolutely. I mean, we see that slowing predominantly coming out of the US. We think Europe's improving very slightly, but still somewhat subdued, and Chinese growth will probably slowly, or slow down to probably about 4.5% GDP growth. So it's really in the US, the impact of those tariff headwinds, slowing consumption and forward orders. But to your point, the offset is going to be lower interest rates, which are occurring in many countries around the world. And obviously the market is now pricing for the Fed to cut in September, but also you've obviously got the offsets through increased fiscal spending in places like Europe, and obviously things like the One Big Beautiful Bill in the US as well, which will be supportive. Also from a China perspective, obviously the policymakers there will be focused on trying to hit a 5% GDP growth target. And whilst we're not expecting any big bang stimulus, we do see continued infrastructure spending and some longer term structural reforms is quite likely.
All right, so you're looking perhaps at that subtrend global growth, but no recession. So how do you adjust for that?
Yeah, look, I think the problem being is that we've obviously had a very strong rally, obviously up sort of 35%, I think, for the S&P 500 from those April lows. Many asset classes are looking fairly to fully valued. So from an investment perspective, we don't think portfolios are going to give you the same sort of returns that we saw in FY25 and FY26. We've obviously seen some very strong returns across a range of different asset classes. We want to remain diversified to capture any upside, but also protect against any sort of unexpected news to the downside. So within equity markets, despite the solid momentum that we've been seeing, we do think headline valuations are expensive and that global economic growth is slowing. So we're tactically slightly underweight there. However, I would make the point that despite that slowing global economic growth, international equity markets earnings growth forecasts are very strong. Obviously, we've seen that through US reporting season, and that's really that ongoing strength in the US IT sector or tech sector, and the broadening of growth in other geographies, but also in other industries as rate cuts start to filter through across FY26. From an Australian perspective, the underlying economy and consumer looking like it's improving or it will improve over the course of this year. And therefore, the broader industrial space is better placed to capture that. So we actually think that in this current sort of market environment, from an equities perspective, you want to be probably using active managers because there's a range or a greater opportunity set to deliver stronger returns than the index. And then when you look across other asset classes, you look at things like real assets. We think property and infrastructure will still benefit from those lower interest rates and defensive cash flows. Australian listed credit looks okay given the supportive macro backdrop. And from a fixed interest and a cash perspective, we have been overweight there. We're reducing that to a more neutral weighting, given the lower expected return profile going forward. But on a relative basis, we'd still say bonds probably relatively attractive on a valuation basis versus equities. So there's still a place in client portfolios.
So I see you're looking at earnings per share for the year ahead. 10% for the US, around 3.5% for Aussie equities. How have you arrived at that?
So that's just looking, predominantly we're looking at the US, which is around just under 70% of global equity markets. That's growing very low double digit, probably sort of 10 to 12%. And then you're getting that broadening in other areas coming through. So it's a more diversified across a whole range of different industries rather than just that tech sector or that concentration. So I think that's positive from an international equities perspective and will be supportive in nature. It's just, as I sort of said, some of the headline valuations, which are a little bit of a concern. And from an Australian equity perspective, really the growth into FY26 being driven by that industrials market. The banking sector is, somewhat subdued. We've seen, obviously, from CBA yesterday, competition's a bit more intense. Margins might be under a little bit of pressure as rates come down. So that's a bit of a challenge there. And really, the resources sector will be interesting to watch because obviously if global economic growth is slowing, that can have a bit of an adverse impact on commodity prices. However, the move in China towards this sort of anti-involution could see the supply side reform actually assist commodity prices. So at the moment, there's not a lot of growth factored in for the resources sector, but that can change should we get some more of that supply side reform.
So what's an appropriate allocation you see in your portfolio at the moment, Grant, with a view to exposure to Australia, the US, perhaps more globally with emerging markets?
Yeah, look, I think emerging markets is one which we've been looking at more closely, more recently. We've seen those particular areas benefit from some of the lower rates and obviously a little bit of that pull forward in demand. Obviously, you've also got a number of governments and corporates renegotiating trade deals and considering those US protectionist policies. So looking at where redirecting trade flows effectively, but also I think the US dollar and some of the headwinds that is facing will be supportive to some of the Asian and emerging markets as well. So we do want to have exposure to equities, but we're just sort of saying headline valuations, especially probably from a US and Australian perspective, just a bit ritzy for us at the moment. We want exposure there. We're broadly neutral, those real assets, slightly underweight the equities and with a bit more exposure in emerging markets coming through, and still happy to have a little bit of defensive exposure through fixed interest, but probably more on the Australian credit side of things.